Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets.
Ice raw sugar, New York. So, the more we move on, the more it stays the same. Yet again, there seems to be one major immediate feature in this market and one other possible feature that might or may develop. The major immediate feature is what is now the late September to date dark blue bear channel, currently 2018 to 22.26. This developed from what was originally a descending wedge pattern, morphing later into a larger bear channel. Now, prices recently have played around a small congestion band between 2140 to 2148, made up of the 50% Fibonacci line of the March 21 to October 23 move and a November 2017 high, respectively, eventually moving below it. However, as I highlighted last week, the next congestion below is the 2084 to 2069 band, with below that congestion at 2047 and in between the mauve medium moving average, currently 2064, and below that the gold long moving average, currently 2037. This was enough to force prices back up late last week over the 2140 to 2148 congestion, though not as far as the overhead green short medium moving average, that's currently at 2205, which had capped prices 2 weeks ago. However, taking a step back for a moment, look and see how over all of this there is a congestion band below from back in January to February 2017 between 2010 and 21 even. So these congestion bands, these moving averages and the lower dark blue bear channel below, currently at 2018, they will be tougher to deal with than the earlier ones. Okay, so now to the possibility, and that is to look at the whole early September to date action as either a topping action with potential back down to the 19 cents level, maybe even lower, or as a potential bullish halfway hesitation, or potential up as high as possibly 26 cents. This is a big picture item, and as I've already mentioned, it is all just a possibility right now and would require further study of the market actions, especially which way the market would move outside the dark blue bear channel before committing to a side. However, I just wish to make sure that you are aware of these possibilities rather than just getting surprised by them at the last moment. Ice Europe white sugar in London. From the lopsided island top formed over late September, this market has been gradually moving sideways to a little lower, and in the process getting itself trapped between three moving averages, despite a breakout 4 weeks ago that eventually, once again, managed to get itself trapped again in amongst the moving averages. So on the top side is the gold long moving average, currently at 565.20, that has been assisted at a distance by the dark blue upper trend line extension and downtrend, currently 582.5, of the January to September this year descending triangle, as well as in the past by the 50% Fibonacci line of the July 21 to November 23 move at 592.80. As for support, we had seen this sort of from the green short medium moving average, currently 563.40, but this proved to be a mirage, and this green moving average has been acting more as a nuisance than as a support, though it seems to be allying, I'll get it right, allying with the resistance of the gold long moving average right now, though I have my doubts about still being no more than a nuisance perhaps. So that details what is topside. Now looking below, we have the flatlining mauve medium moving average, currently at 549.60, along with the March 2017 high at 548.70 and a lesser Fibonacci line at 550.20. These three all worked together until that aberration 3 weeks ago when prices sallied lower but were quickly turned back up by a bullish hammer pattern, and with changeover as well. So we've ended up back within the nest of moving averages, with the slowly declining gold long moving average overhead and below the previously breached again these last 2 weeks, but with no stabilization below it, though I personally suggest that the support breach now a few times may not be as strong as seen before November's fall. Nevertheless, I think the overall picture is the same as I said 4 weeks ago, and I quote, "In the meantime, until we break one way or another, the market seems capped by the gold long moving average overhead and supported by the mauve medium moving average below." End of quote. Sugar white premium spread. 32 weeks ago, the market made a huge combined weekly key reversal down and bearish engulfing pattern. I suspect this was in large part due to London sugar month changeovers, but it nevertheless was a seminal moment and set in motion a lower market, though prices took their own sweet time in getting down there, hesitating between mid-July to mid-September, then testing the lows of early to mid-October last year, down in the 115 3/4 to 116 zone. 13 weeks ago, I highlighted a significant weekly pattern, an immediate countering key reversal down and bearish engulfing pattern, which led to prices punching down through the 115 3/4 to 116 zone, and then down through the next congestion zone below that, made up of lesser Fibonacci lines at 107 3/4 and 104 1/2. I spoke 12 weeks ago about supports below, and I quote, "The next support of note would be the lows of the first week of February 2023 at 83 even, the mid-February low at 83 3/4, and the early February low at 81 3/4. End of quote. I continued further, and it is an important piece I dealt with. And I quote, "The only other feature to consider is a new one I've drawn on my weekly chart, which is not as yet established, but which deserves consideration. It is the April to date descending wedge pattern, currently 71 even to 99 even. It's dropped below 100 this week, so it was above 100, it's now 99. This is still a nascent pattern, but one worth watching." End of quote. 12 weeks ago, prices breached and closed below this pattern. It was no longer a nascent pattern, but the main one. Prices next made a big attempt since early October to move down below not only the lower ascending wedge trend line, but also the important purple neckline extension to the significant February to September 2020 head and shoulders top, currently at 77 even. Now, prices did manage to press lower 4 weeks ago, dropping down to below the November 2021 low at 68 even, but despite a strong move lower, the market was not able to sustain the move down. We are back up, back within the descending wedge pattern, though admittedly this time capped by resistance from, as I quoted earlier, the lows of the first week of February 23 at 83 even, the mid-February low at 83 3/4, and the early February low at 81 3/4, end of quote. I will, as I said last week, and I quote, "Now be watching carefully the action between 85 even overhead and the purple neckline below," end of quote. Okay, so what have we in the way of opportunities and barriers on the downside and on the top side? I'll try and keep it simple and short, as the much larger picture has even me somewhat scared. So below the dark blue lower trend line, we still have the November 2021 low at 68 even, and then a congestion zone between 55 down to 45, dating from July to September 2021. In the bigger picture, well, I had previously looked for opportunities presented by the break below the descending wedge pattern. The primary target, as I said in previous conferences, has earlier been reached. However, the secondary, much harder to reach target X1, well, that is well off, quite a way lower, way down in the 1 even area. Yes, 1 even. And this has gotten me somewhat scared for a number of weeks, as this is way down below what I know to be the prior lows here, notably my 2009 low at 22 1/4. All this is without even considering the implications that just possibly the move lower may have triggered targets. Finally, triggered targets for the huge 2022 to 2023 diamond top pattern. And on that, well, I shudder at the thought of it. Meanwhile, looking topside, well, we have Fibonacci congestion at 104 1/2 and 107 3/4. But we also have a changeover gap from September this year between 109 1/4 down to 100. And though it is a changeover gap, it still deserves consideration should prices try up that high. Just be aware that up there, we also have the upper downtrend nearby of the dark blue descending wedge pattern. That's currently at 99 even, and its seeming constant companion, the medium moving average, currently at 101 3/4. And in the last look at this market, I'm considering for next time possibly the whole action of the descending wedge pattern may actually be perhaps a descending bear channel. But I will look at that next time.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.